An index fund is a type of investment fund that aims to match the performance of a specific market index, like the S&P 500. Instead of paying expensive fund managers to pick stocks, an index fund simply buys all the stocks in the index in the same proportions. If Apple makes up 6% of the S&P 500, the fund holds 6% in Apple. This passive approach means extremely low fees, often just 0.03% per year compared to 1% or more for actively managed funds. That difference might sound small, but over 40 years of investing, it can mean hundreds of thousands of dollars more in your retirement account. Here's a fact that surprises most people. Over any 15-year period, roughly 90% of actively managed funds underperform their benchmark index. The reasons are simple. High fees eat into returns every year, and it's nearly impossible to consistently pick winners in an efficient market. Even the pros who beat the market one year rarely do it consistently over decades. Index funds remove human emotion and bias from the equation. They don't panic sell during crashes or chase hot stocks during bubbles. They simply hold the market, which over long periods has always gone up despite short-term volatility. Getting started is remarkably simple. Open a brokerage account with any major broker since most now offer commission-free trading. Decide on your asset allocation based on your age and risk tolerance. Buy a total U.S. stock market index fund for domestic exposure and a total international index fund for global diversification. Add a bond index fund for stability. Then set up automatic monthly contributions and forget about it. This buy-and-hold strategy, often called the Boglehead approach named after Vanguard founder Jack Bogle, has created more millionaires than any stock-picking strategy in history. And that aims to match the performance of a specific market index, like the S&P 500. Instead of paying expensive fund managers to pick stocks, an index fund simply buys all the stocks in the index in